Hi, happy Agent Tip Day. This one is about when you're dealing with a client that has inherited a property. So who's dealt with that before, right? So there are different ways that they can escape capital gains. So we're going to talk about that today. So number one, let's say your client inherited a property and they call you and they're like, oh my gosh, grandpa gave me this property and I need to avoid capital gains because, oh my goodness, he's had this house since 1965. Like, I can't imagine the capital gains tax that's going to be on that thing. I'm afraid to sell it. Well, first off, you can tell them that there's something called stepped up basis. That means that the quality, like let's say, grandpa bought it 1965, it was worth, $25,000 and now it's worth $450,000. Well, the first thing that you need to say is, listen, that difference in cost doesn't matter because the IRS is going to look at a stepped up basis. This is something that protects somebody from inheriting property and having to pay a lot of tax because most people can't pay the difference between that 450 and the 50,000 that grandpa might have bought it for. So there is a stepped up price that is the value of the property when it was inherited. So in other words, on the date of death of that person who owned the house. So there are three different ways you can avoid paying a lot of taxes or any at all sometimes in some cases. So number one, sell immediately. Make sure that they get an appraisal. Put it at the sale price for the appraisal. And if it sells for the stepped up value, there's no taxes owed whatsoever. Okay. Now, you might be thinking that's a really good thing. Okay. So grandpa bought it and for 50,000. It's now worth 450,000 and it's all coming to me. Oh my goodness. And I don't have to pay taxes on that? You do not. Isn't that beautiful? So that's number one. That's one way to do it. Number two is you can make it a primary residence. And let's say sell your house. Well, you sell your house if you've lived in it for 2 of the last 5 years or 20 of the last whatever. So 2 of the last 5 years, there's no capital gains up to $500,000. Okay. If you're a married couple and up to, I think it's 250 for a single person. So move into it, make it the primary residence, okay? If you make it the primary residence now for 2 out of the next 5 years, so in 2 years, if you go to sell it again after that, there's no capital gains unless there's a massive difference in price, which there wouldn't be. Number three, you could make it an investment property and then do a 1031 exchange. So here's your three ways of doing this. Number one, sell it right away. Number two, um, let it become your primary residence. And number three, make it into an investment property. And then once you sell it, you can do a 1031 exchange, and that would help with the taxes. 1031 exchanges are a completely different animal than a regular sale, but it basically goes through an attorney, with a 1031 exchange, which is a whole other separate tip for another day. Okay, so that's one, two, three. Now, let's say your client calls you, they say, oh my gosh, I don't want to pay capital gains. I'm concerned. I think I inherited this property. It might be too much that I don't know how I'm going to pay for it. And you say, listen, it's okay. Let's just make sure of what the value of it is. And yes, you can do a CMA, but your CMA is not as good as an appraisal. So I would say in this case, you would want your client to hire an appraiser. Now, any cost included in this can come off of the value difference too. So let's say you hire an appraiser, that appraiser is going to cost $1,000. That may be high, it might cost $250. Depends on the property, right? So let's say they charge $500. They come out, they do an appraisal, and your client has spent $500. Well, they go and they sell that property, and there's $2,000 difference between what that appraiser says it's worth and what it actually sells for. Let's say you made $2,000. Well, there's a $2,000 difference in that the stepped up value and the value it actually sold for. But did your seller have to pay for compensation? Yeah, because you got paid, right? You got paid, the appraiser got paid, and they probably paid the buyer's agent. So you can take all of those items off the difference between the sale price and the stepped up value at the date of death. So the first thing you want to do is make sure how title is held. Okay. If it's in a trust is different than if it's held just by a person, right? So you'll have to deal with a trustee, but find out how title is held. Number two, make sure that your person has gone to the probate office. There are a lot of people that don't even know that they have to go to court and they have to ask for letters of testamentary to say, hey, I am the executor. We do have a will. The property still probably will have to go through probate, but it's a quicker process. If you have letters of testamentary, now you can sign documents, right? You can sign the contract, you can sign all, because you're going to look at somebody else is going to look at the deed and they're going to say, well, it says that Clarence Jones owns this house, not Robert Stevens. Well, Robert Stevens is the son. He just, maybe he was the stepson, but he's the one who inherited the property. And so he's the one that's the rightful heir. And that rightful heir will need to get a letter of testamentary to say, hey, I'm the executor of the will. And this property, I do have the right to go ahead and list it. Now, I will say this, because there are times where you might get a letter of testamentary that does not include the sale of the house yet. There are mitigating circumstances, I guess you could say. So whenever you get that letter of testamentary and your client has sent it to you, send it to your favorite attorney and just say, hey, my seller here, Robert Stevens, if that's the name I used, Robert Stevens says he's inherited this property from his grandfather or from his father. And, we just need to make sure that he can go ahead and sign the listing agreement and sign for purchase and sale. And your attorney is going to look at it real quickly and be able to tell you for sure. They're not going to balk at that if they're a good closing attorney. And so Andy Hartman is our preferred closing attorney, Hartman Law, and they will be glad to answer those questions for you. Okay. So the first thing is get those letters of testamentary. Find out who holds title, get a letter of testamentary, make sure that the property is secured, that it has locks on it and keys to it that actually work. The windows are all locked, doors are locked, make sure that it's maintained properly, that it's not overgrown with with weeds or whatever. I mean, there are times that somebody ends up in a nursing home or somebody ends up in the hospital and nobody thinks about, oh my gosh, we got to take care of the yard and take care of the bushes. So now you start getting people going, wonder if this is vacant. And maybe we can, pry open the back door and get in. You don't want that. So you want to make sure that the property is secured and that it's maintained properly. And then get that appraisal. The appraisal, what you want to ask for is a death date appraisal. This is typically a different type of appraisal. Appraisals are done for many reasons. So this is a death date appraisal based upon the certificate, the death certificate. So you need to, hire a licensed appraiser that knows how to do that kind of an appraisal and have that on hand. Now, it also makes it nice and easy when you go to list the property to be able to say, hey, I already have an appraisal on this. So I know it's at value or a little bit below value or just slightly above, whatever, and you can just say, we have an appraisal. So let's talk about an example. Okay. Let's say grandpa in 1956 bought this beautiful property with, say, 5 acres of land. He had gardens, he had a shed built, beautiful, secondary detached garage. even maybe put in a pool. Anyway, he bought it for $15,000 and he did some improvements to it over the years, but he bought it in 1956. $15,000 was actually above the average in 1956. The average in 1956 was like $11,300. Can you imagine? Of course, people didn't make any money back then either, like 30 cents an hour or something crazy. But anyway, so Grandpa lived in that house his whole life from 1956 on, and he had passed away. He passed away July 1st of 2026. So he had a good, long life. That's actually quite a good long life. So you got an appraisal. You know what the value of that property might be now? $545,000 on July 1st of 2026. So you got an appraisal for the death date and it's 545,000. So, okay. Seller's super excited because that's over $500,000 that they have inherited from Grandpa. That's amazing. Maybe they have to split it with a sibling. Whichever. I mean, that's still a substantial amount of money. So they want you to market that thing right away. So you put it on the market, and in September 2026, it sells for $549,000 because everyone looks at this property and it's just beautiful. Maybe you did a little bit to it that didn't cost much money. Keep that in mind if you did, or if the seller did. But it sells for $549,000. So now you're sweating it because there's capital gains, right? Okay, capital gains is $4,000. There's capital gains between 545 and 549 of $4,000. That's all. Okay, $4,000 in capital gains. So what do you have to pay out of that? What does the seller have to pay out of that? Well, $4,000. Did you get paid? Because if you did, that comes off of it. And I would think a $549,000 sale, you're going to be paid more than $4,000. So you'd have zero. The seller would have zero amount of capital gains. And if you want to, you can even figure that in. Let's say it sells for $559,000 or $569 or whatever. Still think about all the things that went into the cost of that. So let's say you had it repainted because, or maybe you had to get an ozone machine because Grandpa smoked up until like 1995, and the place still smells like cigarettes. Ugh. Or maybe it had shag carpet from the 70s in it, and you're like, oh my gosh, we got to get rid of this and bring the hardwood floors up. Everything's going to cost money. Anything that you put into the home, okay, as a price, it's going to cost money. Anything out of that comes out of the profit. So if there was a profit of, let's say, $20,000, when it's between the appraised value of 545, but you added $20,000 to the sale price, right? So that's what, $565,000. Now figure in 6% commission, if that's what you received. Figure in what it costs to rip up all that carpet and have it pulled out. Let's think about the ozone machine. How long? I mean, you had to rent probably 3 of them if he was a smoker, and it took 3 days to get that smell out of there. Well, what's the rental cost for that? How much did it cost for the paint to repaint the place? Maybe to fix up the mailbox or whatever else that you needed to do. Don't be afraid to put a little bit of things into it if you can get more money for it, right? Because you still are going to probably pay over $20,000 for all of those things, right? And so the difference between the sales price minus all of the expenses minus the appraised value is what's left over. So let's say there is $4,000 in actual capital gains at the end of the deal. Okay. It depends on you and your tax bracket, whether or not you're going to pay anything. Because you could be under a certain tax bracket and pay nothing in capital gains for $4,000. You could be in a 15% tax bracket. Well, 15% tax bracket means you'll pay $600. $600. Now, if you're receiving $500,000, does $600 really make that big of a difference? Even if you're in a 20% tax bracket, that's $800. So what a great deal to inherit property. And, this is something that as realtors, we need to understand so that we can help, as people are passing, help them deal with, you know, with the loved one's assets when it comes to real estate. Because if they don't understand, they may be holding on to this property. And we've all seen that property sitting in a neighborhood where, they mow the grass, they have somebody come and trim the hedges. Somebody comes and, makes sure that the mail gets stopped, but no one's living there. And you can tell over time, it's just sitting and it's vacant. And what's happening to that vacant house? So somebody's paying electricity or not. And if not, now you've got a mold situation. Is your value going to be there? Like if they don't know what to do, and so many people don't know what to do, this is what we're here for, to help educate the public, to help them with their investments and do the right thing. So I think inherited properties is a great avenue to run down. There's a lot more to it that I didn't get into in this agent tip. If you have any more questions, please reach out to me or reach out to your, favorite attorney, Hartman Law, or whomever that might be. But we'll go over this again, okay? Avoid taxes by selling immediately, or avoid taxes by making it a primary residence, or avoid your taxes by making it an investment property, all right, and then putting it in a 1031 exchange. That's for another tip. Dana Sparks has a fantastic video on 1031 exchanges, and we have classes on that now and then. If you have a seller reach out to you, you want to make sure that you find out how title is held. You need to make sure that the seller goes to the courthouse and gets to probate court and gets a letter of testamentary. Take that letter of testamentary to your closing attorney and make sure that they can actually sign the listing documents. Make sure that they are securing the property, maintaining the property so that it doesn't look like a rundown property, and then get that appraisal done, a death date appraisal. It's very important that it's a death date appraisal for the capital gains and for the IRS. And then follow the little path, right? Take a look at these properties that have been sitting. Maybe you can help somebody. Maybe the property has been sitting for 3 years. Okay. So we've all had price increases in those 3 years, maybe 5 years even, right? We've seen pretty significant in some areas and pretty significant property value rates go up. But even after 5 years, like let's say it's, the house was worth 400,000 on the death date, right? And now it's worth 450. Well, there's 450,000. So there's $50,000 difference there. What is compensation at 6% on $450,000? Okay, so there's that. Plus, if it's been sitting there for 5 years, and let's say the electricity was off and you have to go in and, make sure that the HVAC is serviced, make sure that there aren't any leaks, make sure that it gets electricity on and water on and gas on or whatever is needed, there are going to be expenses. You might want to repaint. All of those things, remember, comes off that $50,000 so that your sellers can still end up with quite a gain and not a huge capital gains tax. I hope this class was, this little agent tip, it wasn't a class, but this agent tip is helpful for you to go and garner more business and help people in our community with their inherited properties. Have a great day.